Hello, welcome to this webinar, Cyber Risk, a CIO Perspective on Digital Transformation. I'm your host, Simon Marvel, founder and CEO of Acuity Risk Management, and I'm delighted to be joined today by Phil Clayson, a very experienced Chief Information Officer. We're also going to run some polls as we go through the session to get the audience's views on some questions. Our contact details are on the screen. Please feel free to contact us. You can see our email addresses and LinkedIn contacts there if you'd like to reach out to us at a later date. Now, this is the first webinar in a series of 4. On the 5th of August, we're going to be talking about Beyond GRC, risk and compliance in the digital era. And we'll be talking about limitations of traditional GRC approaches and also what a good risk and compliance program looks like in the digital world. On the 26th of August, we'll be covering transitioning from GRC, creating holistic risk management, and we'll be getting down to the specifics about how to build a risk strategy ready for today's digital economy. And then on the 16th of September, integrated risk management stream in action, we'll be getting down into looking at how you can transition effectively from point GRC solutions to a fully integrated risk management solution, which is aligned with your digital strategy. The agenda for today, I'm just going to say a few words of introduction around digital transformation and risks in the digital era, and then we'll go on to get Phil's perspective on these issues through a discussion. What do we mean by digital transformation? This is from the World Economic Forum. It's clear that the world is being transformed by new technologies, which are redefining customer expectations, enabling businesses to meet these new expectations and changing the way people live and work. And digital transformation, as this is commonly called, has immense potential to change consumer lives, create value for business, and unlock broader societal benefits. And this is reflected in the numbers, with the analyst IDC forecasting that by 2022, annual spend on digital transformation is going to be approaching $2 trillion. The World Economic Forum are estimating $100 trillion worth of economic value being created over the next decade. And IDC are predicting that by 2023, we'll have reached digital supremacy, so more than 50% of the world economy relating to digital. And this is going to have an enormous impact on businesses, and those that are not able to compete in the digital economy will be increasingly unable to compete in their core markets. What about COVID-19, I can hear you asking? Well, there's growing recognition, I think, that there'll be no back to normal following the pandemic. Businesses will face tremendous challenges. According to PwC, nearly half of finance leaders expect revenue to decline by more than 10% this year, and 53% are anticipating a decrease in profits of more than 25%. 52% of CFOs plan to make remote working permanent, so that's a huge change. But digital transformation, which was already well underway, is accelerating as a result of the pandemic. PwC found in their survey that 82% of CEOs consider that digital transformation is strategically important going forward. Again, according to PwC, businesses are pursuing change across many dimensions to try and regain the growth that's been lost through the pandemic. Changes to products or service offerings, whether new or repurposed, are by far the most pressing, according to 63% of PwC's CFO survey. And this underscores the fact that innovation will be a driving factor during the recovery period. There's going to be a growing need for new ways of working to enhance the creativity required to sustain this innovation, for example, for new tools, new behaviors, and reinforcing incentives and rewards. On the positive side, in the same PwC survey, 72% of CFOs believe that they'll be more resilient and agile in the long run. 53% say the new ways they're serving customers will put them in a better position down the road. However, though, reflecting the shock of the pandemic, 60% of CFOs are saying that tech investments in the future must be crisis-proof. Just looking at the areas where cost cutting is already happening, Digital transformation spend is relatively well protected. Only 11% of organizations are considering cutting expenditure in this area, compared to 31% looking at cutting in more general IT areas. In fact, IDC are forecasting a 10.4% growth in 2020, even after taking account of the pandemic. And as we can see, cybersecurity is protected. Only 3% of organizations are considering cutting expenditure in this area. Digital transformation has a very wide-ranging scope. It's already underway at many organizations with the application of new technologies such as robots, Internet of Things, artificial intelligence, cloud computing, predictive analytics, and blockchain. And it's also happening at a rapid pace. Whilst it creates new opportunities, it also creates new risks. Some of those are illustrated on the screen here. And business leaders are making strategic choices on the investment, the technology, resourcing levels, and the skills needed to operate a digital business. Also, which third parties to partner with and how they'll comply with regulations and so on. And all of these choices will have an impact on the short-term profitability and the long-term viability of their businesses, and all of them involve risk. At the same time, businesses must deal with external threats. For example, as businesses undergo digital transformation, more of their assets become digital. The threat of cybercrime and risks around data privacy are growing. And CIOs, along with CISOs, are at the forefront of digital transformation and the management of risk that comes along with it. GRC solutions, traditionally used to manage risk, are struggling to meet the demands of today's progressive executives, unable to adapt to the dynamic needs of the digital economy. So how should today's executives manage risk in the age of digital transformation? And to answer this question, I'm going to bring in Phil Clayson and start by asking, Phil, could you please tell us a bit about yourself and your experiences with digital transformation?
Yes, so thank you, Simon. Good to be here to share some thoughts on risk management. I will sort of give you thoughts on risk management generally, but also on cyber risk, which has formed a big part of my recent career. By way of a shortish introduction, I've spent about 15 years delivering a range of transformation from M&A to turnarounds, and in the last 5 years especially have focused even more so on the digital end of that transformation, but then increasing focus on the cyber components of that digital transformation. So I've been really fortunate to experience a range of sizes of transformation in a range of sectors, from business rationalization through an actual major cyber breach, public cyber breach remediation. So amongst other things in that transformation are tech debt removal, and naturally a number of risks get addressed when you sort of start engaging on those kinds of activities. My view generally on sort of risk and risk management is it's not particularly well done in most organizations, regardless of transformation. It's generally something which is at a low maturity scale, done in a fairly basic way, often seen as a necessity, a secondary, even less prioritized task than perhaps secondary would imply. It doesn't need to be like that. I don't think it's a really risk management done properly is a really strong mechanism to get the business looking at the right things in the right way. You can use it effectively to get investments approved. You can get the board focused correctly on the risks they need to address, which by and large will also align to a business strategy if you have the correct view of risk. And many of us, I think, probably see risks as something we just have to endure. We probably put them on a spreadsheet, which surely that's not the right answer in today's society. But we'll explore some of those things, I think, in a little bit more detail as we go through the session and then the Q&A this afternoon. So I think the first question that Simon has posed, what is my experience with transformation? Well, I think I've given you a quick introduction to the majority of the work that I've been doing. I've worked across broadcast and telecoms, video streaming, betting, property, energy. So I've done a broad cross sector. So every sector I've experienced is at a different stage in its investment cycle in terms of product and service, and therefore has a different risk profile. It operates in a different competitive marketplace, has a different demographic of customer base, and therefore does things differently. But I think the thing I've noticed most, the experience I've probably has the sort of the most common occurrence, is that most people are reactive to risk in many cases. all the companies I've worked with are transforming at some point, and the risks they potentially could foresee in that transformation. Yet so often those companies get caught out partway through a transformation, and most of those companies seem to be working on the premise that it's the shop window that's the most important part of where their risk needs to be managed. They don't often necessarily look too far back into the engine room of the business, and that can be a problem. We'll probably come across that a little bit later in the session. And I think in sort of summary, the experience that I've got really, it's seen as the same problem. I think whether you're trading locally in one country or whether you're trading internationally across borders, in some cases, big worldwide organizations struggle just as much as smaller local organizations. So I think when we look at risk overall, and we look at cyber risk especially, I think all of the businesses I would work for have initially scored quite low on a maturity scale for managing risk and cyber risk, digital transformation based risk.
Okay, lovely. Thank you for that introduction, Phil. I just wonder, over your time as a CIO and in your experience more recently, I guess, what new challenges and risks does digital transformation bring?
Yeah, I mean, there's many. I think the three things I probably see the most often, and not necessarily in this order, but risks related to legacy IT, risks related to just general lack of awareness, and that might be a lack of knowledge or it might be a lack of interest, but it's a sort of alertness, awareness dynamic. And then the risks that are introduced because organizations are trying to go faster than perhaps the governance would allow. And that doesn't mean I like to slow things down by any stretch, but just being cognizant of the pace you're running at within the, as I mentioned just now, within the dynamic of the industry you're in, geographically, functionally, sector-wise, and understand what pace you can achieve and also manage a decent risk profile in the meantime. So in terms of the first one, then in terms of legacy, I think many businesses have done a really decent job of evolving their front end. So their shop window, as I call it, has been developed well. Applications have been introduced into the mobile ecosystems. Websites have been improved, and journeys are becoming more featured over time. But I think that in some cases, those organizations haven't looked backwards into what I call their engine room in the same level of detail or with the same care, and thus they have a really shiny front end to the business in some cases, but a pretty concerning back end to the business. So they're carrying huge amounts of legacy IT and the tech debt, as it's called, in that back office. Many have materially underinvested in removing that tech debt and are now fighting an uphill battle to try and recover that at a time when in a COVID era companies have been reducing budgets, as we've just seen in IT. In general, capex is one of the first things to get hit. I think that's created already and will further create a bit of a time bomb from a risk perspective, especially if you think of cyber risk. I think those risks will be needing to be addressed, and it will become the longer you leave it, the more expensive it becomes to deal with. And I think businesses have, in terms of the legacy IT piece, I think businesses have failed perhaps to run a strategy which addresses front end and back end together. They focused on the one and not the other, and I think that's going to be a major problem for properly executed transformation going forwards. I think the sort of second point on general awareness and attention or alertness to, alert is a new word, but alertness to detail. A lot of companies treat risk as a bit of a periodic thing. You look at it once a quarter or once a month, or on a sort of cyclic basis. Some companies, especially if you're trading internationally or you're listed, some companies will be exceptionally good at looking at the big macroeconomic risks. They might have a bit of a risk culture in their organization, but it is in the organization, not throughout. And therefore, I think there's a bit of awareness that needs to be considered as we think about risk and transformational risk. Quite often, the conversation around risk in those organizations, to me, appears very infrequent. It's sometimes led by the leadership team and the board. It's sometimes led by a very small team of people who are charged with managing risk as part of their unique and discrete role. But I think that those answers are probably wrong. It's not a board accountability to make people aware or pay attention to any form of risk. It's a culture that needs to be bred through the organisation. So you need to start to try and encourage the whole business to think about risk. It's the old sort of getting IT to work with the business and vice versa conversation, but not just about functionality or performance, but about all sorts of risks. In terms of cyber especially, but regulated deliverables present risk to the trading risk to a business. If you don't invest in your platforms, as I mentioned earlier, you'll create a lack of resilience and create an instability in your platforms over time. And that sort of general awareness, that general alertness needs to be sort of considered as in the round, not as an individual sort of periodic thing. If I give you an example, I spent a lot of my early career in the broadcast TV business. How often do you see a TV picture materially disappear for any amount of time? Pretty rare, I would say, in most countries around the world. Why is that? Well, the risk of losing service in a live broadcast is monumentally expensive if you're relying on an advertising stream, or you're in the middle of a major government announcement or sports event. Or I covered the royal wedding in 2011 as part of my role at that time in the UK. So you cannot have a system which is it takes 20 minutes to recover itself, or needs 300 people to do an incident. It has to be live, and so those systems are built with double, triple, sometimes quadruple levels of protection, and that has a cost point. And there are many people that would find that disproportionate to the business they run. But if you want to run a business which has pure customer experience and isn't on the front pages of Down Detector and other services that point out when things have fallen over in the technology space, then those sorts of considerations probably need to be built into your risk profiling or risk management. And if you're doing a transformation, there's no better time to build them in, especially if you haven't addressed them before. And if you can't afford it, or you choose not to, then at least have that properly tracked in your transformation risk register, so that the business knows and signs off on the fact you're building something which has some inherent operational risk built within that. Many companies don't do it. Many companies can't afford to. How many of you on this call have heard the term, well, we'll use our pre-production system in the event of a disaster? Okay, it's one answer. Depends on your business, but it wouldn't be where you would choose to start, I would hope. So I think on the second point around sort of alertness and awareness, it just needs to rethink, and people need to just be really aware of that transformation risk that you're introducing. You don't want to leave behind a legacy that you could have potentially addressed as part of your transformation. And then I think the third point really is about pace. Everybody wants to go quicker these days. It doesn't matter how fast you go. There's always a requirement to, as the developers would say, have more velocity. I think the companies that want to go the quickest will sometimes trade that off against taking a higher risk profile, with the promise that one day I'll go back and fix it. And 99% of the time that never happens, in my experience. And big corporates who have to carry the overhead of regulatory compliance, audit and corporate compliance are competing effectively in the same market with some really small, nimble organizations who don't have the same pain if they create a risk which materializes in an operational way in front of its customers in the future. So small organizations in theory can take more risks. They can probably get away with a bit of a problem because they might have fewer customers, or less impact. They may have less reputational damage, or they may not be regulated. Bigger companies have got to go just as fast, but they carry that massive overhead. So it's a real challenge, I think, in terms of doing a transformation, a digital transformation, if you're a big organization, because you've got to take all that into account. And that's why I think it's really important, to my earlier point, of getting that culture really properly embedded in people, as opposed to having it as a periodic cyclic thing. So quite a sort of long answer, but I think there's a lot to consider in that digital transformation thinking, Simon, on that one.
Thank you very much, Phil. That's great. I thought at this point it might just be interesting to run the first poll. The World Economic Forum sort of identified a number of potential inhibitors to digital transformation. So the question is, what are the main inhibitors to digital transformation in your organization? And you can see that there are a number of options listed there. Select any of them, as many of you like, that apply to your organization. So we have innovator's dilemma, which is the fear of cannibalizing existing revenue. Cultural restrictions, so conservative culture, suspicion of technology, that sort of thing. External factors, so concerns over regulations or compliance. internal factors such as lack of budget, skills, fear of failure, or perhaps something else. Just be interesting to see the results as they come in. So highest we've got internal factors such as lack of budget and skills, closely followed by cultural restrictions, and then innovators' dilemma and external factors neck and neck on 31%. Phil, does that surprise you at all, those results, or are they in line with?
I think it'd be fascinating to have done this pre and post COVID. If you take the lack of budget one, the fourth one, you overlay that your data point from earlier around what goes first, it's arguably discretionary capex. I think there's probably a linkage there somewhere. I'm actually, if I'm honest, I thought it might be slightly more skewed than that in terms of the data. There's, it's not equal, but it's by no means any one thing. Although there's 62% on internal factors, which, if it's internal, then there's an argument that says you can control it to a point. The budget maybe not, a never-ending pot of money, but things like skills and fear of failure can be addressed relatively cost-effectively in most organisations. I've certainly done it in the ones I've worked in recently. So, yeah, interesting spread.
So, Phil, how should organisations think about risk in the digital economy?
Yeah, this one is really interesting. So, I think the first thing is, I think anyone that says they aren't going to go digital is not going to be around for long, and there are still some companies out there that are struggling. I've spoken to some CIOs in the last fortnight who basically said they're still running their businesses in some places on paper, would you believe, not even on Excel. So I think there's a huge push as a result of COVID for people to realise they can't continue like that. It's not viable. So I think the question is, it is going to become a must. It's going to become the right to trade. And we can all think of companies who have been caught out a bit during COVID. And I think I'd be surprised in a year's time if we're not treating our digital strategies in the same way as we've been forced to treat our data strategy with the introduction of the GDPR regulation in Europe. No one these days would hopefully dream of not having a good understanding of their data, be able to manage it, delete it, amend it, etc., in line with those GDPR regulations. But I suspect the boards around that they would have a working knowledge of GDPR at the very minimum, or should have. And I think there are still probably some boards out there that will require more help, more guidance with their digital plans. I think for some companies, they believe having a website is enough, or removing paper, or as you mentioned at the beginning, perhaps having some robots do some work. I think that's not a strategy. That's it's a whack-a-mole tactical. Let's hit a few things and see if it lands. And I think therefore it's going to become an absolute must to have, in terms of organisations thinking about their risk in their digital economy, to have that mapped out as a strategy with the underlying risks that go with it. That will probably mean some investment. So I think the possibility for many to sort of do bits and pieces around digital economy and risk, I think is diminishing. I don't think people can accept that any longer. I think it's going to be a big push over the next, as you said, 2 years to digital supremacy, with 50% or more being included in that figure. So I think we will need to understand how moving through that digital journey translates to risk. Not risk in the risk sense of the transformation itself, but also risk profiling, the decisions you want to make, the strategy you want to take, and having profiled them, then you need to prioritize them. So you won't be able to do everything. Nobody can. And I think therefore there needs to be a really clear action on making sure that people across the business customer base understand what you're working on, what the priority is. I think COVID, if nothing else, managed to prioritize a few businesses into reducing their list of things to do to the very minimum important things. Start with the outcome in mind. Where do you want to get to and why? What does it do to your business strategy? What happens if you can't articulate a strategy, or you articulate a confused one? Your people will be somewhat disillusioned or confused. That won't help. I think as we go forwards, people are going to look at lack of risk and realise they need to probably retrospectively go back and fix some things that they've left in the past. And I think you will find that a different level of risk management or risk awareness becomes sort of natural in these sorts of transformations as we go through. And it is part of an entire thought process. It starts with the business strategy. It works through product strategy and technical strategy, and it's one of those things which just needs to be completely sort of comprehensive and cohesive across the business. Most businesses will probably end up being, if they're not already, will be customer first, digital driven. So the impact of not having a clear understanding of your risk profile, in as much as your customers aren't getting what they want, can't activate their accounts or buy or transact online is important. You've really got to understand what those customers are doing. And these aren't, I think, final point in my thoughts here is, some of these things in the past have been done as slight vanity projects. It's a me too. It's a, well, my competitor's got one, so I'm going to have one. That's probably the wrong answer as well. This becomes, digital becomes a major part of your trading function. It's part of everyone's life in the business. If they don't, and even the people that work in a back office function, whether it's some administrative function or a warehouse or distribution function, they will be digitally enabled. And I think if the business doesn't think of it in those terms, then they're going to come unstuck partly or completely at some point over the next couple of years when they see what the competition is doing in their digital strategy. So, comprehensive, cohesive, wide-ranging, embedded are the sort of the things I think that we should be thinking about as we manage into the new digital economy from a risk perspective.
Thank you. There's some really interesting points there. Have to do it. Have to think about risk at the outset. Have to make it customer focused and deliver on it. So that's great. Phil, how should executives start to transition their risk management strategies for digital transformation?
Yes, I think it was sort of similar theme. We're touching on some similar thoughts, really. But I mean, it is so. The question is about executives. Obviously, the leadership team are the executive team in business. I think they need to, and as CIO, I have to do the same. They need to be thinking as much about how they're going to take their customers on that journey. The cost basis of the business I've worked in could be materially lower if people didn't ring in every few weeks to ask a question. They do that in some cases because they can't answer that question online. So that's there's a cost saving option there as well. But I think the other things are looking outwards from a business. The executives need to understand what the customers want and need, and then encourage them, in commercial terms and tariffs and charges for not ringing in when they can do something at a lower cost base on a digital platform. But executives also need to look at what's going on within their own structures, own teams, the culture of the business, and the amount of investment that's going into that business to make it digital, make everyone digital aware. And I think that those things need to be measured. I mentioned vanity projects earlier. I think there's been a number of companies over the years that have done a vanity project, and it doesn't have a measurable outcome. It might be the right answer, but it hasn't been measured effectively. And I think the exec team, working with development engineers and testers and architects and all the people that make these things a reality, I think that exec team needs to understand what the shared measures are and agree it with the business, so that everyone is brought into one set of objectives with one measurement criteria around them. And then I think as you then trade through your business, you can then add the features that you need in the digital space. You can digitize the teams that need to be taken off of paper, and you start to then see some real benefits. But as I said earlier, you need to do it with a proper plan in mind. And I think as you identify what are the things you need to do, what your customers need to do, what your teams need to do internally, I think very carefully through the risk profile of each of the modules of transformation that you're delivering, and whether those modules actually link together. There's a risk in itself. Profile each of the activities that is going on in terms of risk, and then develop a plan that proactively and regularly looks at that risk, manages it down, finds opportunities to mitigate risks where you possibly can. And I think if you are profiling those risks correctly as an exec team and as a developer community and as a business community, you will quite quickly find the ones that everyone agrees. So certainly I feel in my teams, we find the risks that we quite quickly agree need to be dealt with. And then people get behind them, and then they are motivated and incentivized to make it happen when budgets and things become available. But it's very controlled. It's not people's wish list projects. It's structurally done against a proper business. And always obviously against the backdrop of digital transformation. So we are running a business. Digital is just one angle of that business. And to ensure that digital overlay, whether it's cyber or GDPR or whatever is in place, is absolutely critical. I think once you've got all that sorted and you know what your profile of business looks like, and you know what the risk profile of everything you're trying to do is, and you can attribute a cost and a time to working on mitigating those risks, then I think you'll end up with less of a situation where you get competing priorities and people have complex views and etc. Because you've built that risk profile, you've built that digital strategy as a team, and you understand what the opportunities are, and there's no surprises basically. So if you don't know what your risks are because you don't know what you're trying to do, then there's no way you can measure them, and there's certainly no way you can then try and address them effectively. And then carry on like that, carry on with the conversation, make sure it goes round and round in a regular basis. It isn't a quarterly thing or a 6 monthly or annual thing. It is daily, it is hourly, it is every single time, in the same way as you would manage cyber risk or data risk in GDPR. So yeah, that's I think where executives start their transition to a risk management strategy, and start it with risk at the front rather than bolt it on at the end.
Brilliant. I thought it would be interesting just taking account of what Phil's been telling us just there in response to the previous two questions, to bring up another poll and just ask you how you rate your organization's risk management maturity in relation to the needs for digital transformation. So here we have, the question is, how do you rate your organization's risk management maturity? Please could you select one of those? So traditional bell curve came out from there. Medium 42%, low 25%, high 33%. Phil, do you have any thoughts or comments on that?
It's pleasing to think no one thinks their organisation is in the very low category, I suppose. I think it sort of goes to my points earlier that I've never seen anyone do this perfectly. So that probably validates that no one's in the very high category. And I think, as you say, a decent sort of bell curve distribution on the other three. I guess if I drew in my sort of head, if I drew a line under medium, and I said that anyone who works for an organisation that is medium or lower probably has some thinking to do, at least the organisation does, perhaps not the individual. But I think that would probably send a message, and it doesn't happen yet. It may happen in the future, but I've always wondered if company reports, so public companies, if they were made to publish stats on some of these operational metrics. So obviously they publish their financials, but it's rare they publish anything quantitative around cyber. It's very rare they publish anything quantitative around GDPR or data management. They'll talk about sustainability and etc., but they won't necessarily produce some of these other metrics. This one will be fascinating as another metric. How do you rate your risk maturity in the organisation? If they had to publish it, I bet you we would see at least a 1 point increment on each of those bars, and maybe we wouldn't see any lows at all because that wouldn't be publicly acceptable to shareholders. So fascinating. Bell curve corresponds to what I've already said, actually, in that I've not really ever seen it done brilliantly in most organisations. Yeah.
Okay, brilliant, thank you. So just moving on then, I expect you've had experience with several risk management technologies, Phil. What sort of risk management technologies do you think are needed in the digital economy?
Yeah, I think, this one, I'm sure I'm going to make one or two people smile now. I've experienced this before. I suspect there are people on this call, and I've worked for organisations like this, where your risk management is done on Excel. And clearly that's not likely to be an acceptable answer if you want to take risks seriously. Unless you're a very small organisation, probably privately held with fewer than maybe 100 employees and perhaps just doing one thing, I suspect Excel is not going to be the answer. If you're a bigger organisation, hundreds of millions, billions listed, etc., then I don't see how that would be viable. You would run all your finances on Excel, so why would you run risk on Excel as well? So I think Excel is it is really simple. You can't argue Excel is relatively simple to do most tasks in. It is not particularly well controlled in any organisation. It's certainly not particularly secure in any organisation I've worked for. An Excel sheet, even if you password protect it, it's not really secure. Excel is not definitely a tool where you can run reports particularly easily. So I think it doesn't handle updates. It's useless at doing reminders. It doesn't do iterations particularly well, even if you control it with a version control system like SharePoint or something. It's just not particularly a decent tool. But there are dozens of companies out there that I suspect use Excel. So that leads you on to something a bit more sophisticated. I think I've seen everything from very, very complicated, weighted models that don't really tell you anything meaningful, because you could probably sum up what they say in a matter of lines. But I think any platform, whichever platform you pick, has to be pretty straightforward and simple. It's got to be something that an exec can log into and understand their risk profile. And the risk platform I put in most recently, the exec team I worked in, that exec team wanted to have logins and they wanted to see what was going on. They didn't want to be caught out in a board meeting not knowing what's going on in their division. So they were very keen to make sure that they understood how the data was being presented and actually who was working on it. So I think that's a really interesting. So it has to be accessible to the exec, which probably means it's a piece of software, or and these days, my architect team wouldn't let me do anything other than make it a cloud-based piece of software, because that's just not the way things are done. And so it has to be cloud-based, and it'll have to be secure and accessible. So really basic sort of requirements on that, really. You have to be able to phase it. So, I've run businesses that are heavily regulated. I've run businesses that run critical national infrastructure from an IT perspective. And it is not appropriate that some of those risks are visible to anyone other than the direct chain of people that are responsible for managing them. You can't have that widely available. So platforms needs to have, and that's, again, challenge with Excel for those that use it in that environment. You've got to have a platform which manages those risks in a segmented, controlled way. If you think about, for those of you that have been involved in big merger and acquisition plans, or I've been audited and had a fairly duff audit response, or I've got some very great product innovation, some IPR, you wouldn't leave that lying around on an Excel sheet particularly. You would have that somewhere more secure, I would hope. So why leave your risks, which are equally as valuable, in the wrong hands to someone else? I'm not necessarily talking about a project running late risk. This is some of the big stuff needs to go in the system as well. And if, as I've done, if you are in a regulated environment and the auditor has the right to come in at any moment unannounced, and as does the regulator, then you can't be scratching around for a system. So have something which is credible, accessible, is maintained in real time. Goes back to my point on culture a few minutes back. People who have got the right culture will keep those things up to date as part of their day job every single day. That culture has to be bred in as well, and then you'll have something which is highly credible. So I think it doesn't matter whether you are private or public, but you need to think about a tool that is going to cover your entire business. So it's the regulated end of the business. It's your local projects and program management risks. It could be health and safety if you work in, pick a random industry. If you work in, I don't know, food preparation, I'm sure each of your food preparation areas, is regularly reviewed and is kept under control. That's a risk conversation at its heart. So in summary, I think the technology needed has got to be able to support digital transformation. It's no good buying something which doesn't align to that. It's got to be sort of available for all users to engage with. It must be secure, must be real time. And I think those are the sort of things that you need to think about when you're looking at a risk management technology in this space. And then obviously it's got to be readable by the exec, otherwise you're doomed to failure.
Thank you, Phil. Just listening to that, interested in which is the most important characteristic of risk management technologies for the digital economies. There's a number of options here. I'd ask you if you wouldn't mind, please, to just select one of these that you consider to be the most important characteristic. And the choices there are a fast time to value, by which I mean it's easy to contract, quick to set up the platform and configure, upload legacy data, train the users, and so on. Cloud-enabled, secure, easy access for everyone that needs it. Number 3 is holistic, always-on visibility of risk and compliance across all the different types of risk that Phil was mentioning there. So regulatory, cyber, privacy, health and safety, and so on. Agility to react to change, so to react to new risks, new products, new services, and so on, and other. To share the results from there. Tied at top, fast time to value, cloud enabled, easy access, agility to react to change. Sort of interesting to see that they're all sort of given fairly equal weighting. Phil, any surprises to you there?
No, I think, as you say, it's fairly evenly distributed, isn't it? So yeah, really interesting.
Phil, do you have any important hints and tips, immediate takeaways for the audience?
Yeah, I mean, I think if I look back over my, I've got a broad sector experience. It doesn't really matter which industry or certainly my experience, it doesn't matter which industry you go into. I mean, some are highly regulated in terms of risk. If you're on oil platforms or dealing with gas or whatever, that's a slightly different story potentially. And the same is probably true in the health sector. But I think, for most technology style businesses, which is where I've spent most of my time, I think there's most organizations do as good a job as each other. As we saw on the previous poll, none are particularly bad. None are in the low category, but none are in the very high category either. I've never seen anyone do all of it brilliantly or desperately badly. So it is that bell curve in the middle. I think what that probably, and I don't think that's good enough, by the way. I think we should be, I should be drawing my line at the medium on that previous poll, and everyone should be high or very high if they were being measured externally, which I don't think most companies really are or do. If we stand back, regardless of what sector we're all in, and if we said, look, when we were sort of going through the pain of GDPR, there was an awful lot of sharing going on. There was a lot of forums, there was a lot of knowledge, there was a lot of, what does it mean? What the government said? What does this? How do you do this? And there was a huge amount of sharing. And the same was true of COVID, actually. For those of you that have been through the IT phase of that, the amount of support that was offered by system integrators and consulting houses to companies for free in webinars, massive. I think if we did that around risk, it benefits us all, it benefits our business, it benefits the customer, and if it's shared, then it's less painful. So I think, regardless of sector, I think it's probably three big takeaways or tips then I think that I would sort of table. I think, and again, on the context of COVID and GDPR being examples where we have collaborated as industries without barriers and without wanting to be secretive. So I think tip one goes back to the beginning of the session today. Really, plan how to get everyone in the business thinking about risk implicitly and naturally. It's got to be part of the culture. Got to ensure people are comfortable with the language. What is the difference between a probability and an impact? Not everyone can articulate that brilliantly either. How do you articulate risk, and what are the different types of risks that you're dealing with? How do you profile them, as I said earlier? How do you prioritize them, and how do you then get everyone bought into dealing with the things that really matter? And this is as much about generating a roadmap to get things done, whether you're agile or waterfall in development speak, as it is dealing with any other part of your trading business. So I think you can use risk as a tool to incentivize, the finance people and the boards and other folk to recognize where they need to be investing, but so often it's all the negative stuff. It's not the positive product-led items. So get everyone involved, get everyone speaking the same language, make everyone equally accountable, get everyone sharing and reviewing what's going on. So the real-time element of risk is important. Try to make risk, my experience is risk is always seen as the thing which is bad. If you declare a risk and you send your project red or you're over budget or for some reason or other, everyone gets very animated about it. Actually, it's a good thing. It's a little bit like saying I'm not very well, and then people will come around and help you. And I think if you treat risk as a bad thing which gets penalised, sometimes it can be counterproductive. People need to be accountable. They can't just stick a risk up for the fun of it. That's not how it's supposed to work. So some form of accountability, shared dashboard, and generally get everyone on the same agenda at the same level with no differentiation between how people are treated and expected to behave. I think that's probably tip one. So it's about culture more than anything else. I think tip two, don't let anyone feel it's their own thing to do on their own. We so often we've got teams of people that do risk and they feel largely accountable but unempowered to actually deal with anything. They're just there to report. They become a sort of glorified reporting function in some businesses. I think treat it in the same way as now we treat cyber risk. Treat it in the same way as you would a major health and safety risk if your business needs to properly consider health and safety in its daily operations. Sometimes businesses have chief risk officers these days. It's a bit of a new title that's coming out, but so often they don't. And in most businesses that are running technology, it falls to either a CIO or COO or a CISO if it's a cyber risk. And again, it goes to my earlier point, it's not on one person, it's a team gig, and everyone I think needs to play their part, be open, share the challenges and address them together. I think that's probably tip two. So one is cultural and two is making sure that it's sort of spread evenly around. And I think probably then last one, tip three, I think just be really practically clear on how people are going to behave in terms of the platforms that are used, the governance mechanisms that are going to be put in place, how you deal with things that appear left field and aren't actually known about until probably too late in reality. More of that is about the functional, so it's better reporting, probably less panicking, less running around, fewer surprises when something fails. How do you then build that into your long-term plan? So this one is about the mechanism of keeping it going, I think. So 1, culture; 2, making sure it's a shared problem; 3, just make sure everyone's clear on the mechanism on how to actually get this done. So many people in so many businesses I've seen don't even know how to raise a risk on a corporate risk register, let alone how to proactively then address it with the stakeholders that matter. So those are my observations, those 3: culture, and share the pain, and then have a mechanism to make sure everyone's comfortable they can properly manage risk.
Brilliant. Thank you very much, Phil. Come back to you in a couple of seconds, if I may, just with a couple of questions that have come in. But just quickly to say to everybody, if you'd like any further information from us, if you'd like to request a demonstration of our Stream Integrated Risk Management platform, please do contact us. There are white papers for download on the website. There's a long history of other webinars. And of course, please do follow us on social media as well. Just talking about coming back to the other webinars in this series, date for your diary, the 5th of August is the next one, same time, beyond GRC, risk and compliance in the digital era. So looking now at some of the limitations of GRC and how we're going to move forward in the digital world. So there have been a few questions that have come in. I think some of those have been answered as we've actually gone through. There's just 2 that I'd like to put over to you, Phil, if I may. Firstly, what are your thoughts on how best to communicate digital transformation risks to the board?
Okay, so I think it goes back to some of the themes I've sort of picked out. I think if you've got a clear digital transformation plan, so I mentioned knowing what the outcome was largely before you started, and I don't mean that means you take a waterfall approach if you're a development team. It means knowing what you feel good looks like. It doesn't matter how you get there as a journey, it's just knowing where you think you want to be. If you know what that transformation feels like, you know your cost envelope, you know your technology, some of your technology decisions, you know your cultural sort of backdrop, then I think you're very quickly, and obviously that has to be sold to the board. When you sell that digital transformation to the board, then it goes with a series of corresponding risks. And I think you present the 2 together. You don't just present the shiny bit. You present the sort of hairy bit as well. And I think if you do that, then you manage onwards from a point of approval with the board saying yes, we're going to do these things, and then you're managing a cycle of risk around that deliverable. So the board are aware at the outset what you are going to do. They know how much it's going to cost because they'll always ask that question. They will know what your risk profile is, and I would be really careful to make sure you allow yourself time to cover the risk profile bit, because quite often the board will say what's the benefit and how much it's going to cost, and for them that's the end of the conversation. You need to have a conversation around people and culture and risk and cyber and data as well as part of the transformation before the board sign off, and a good board will drill you on all those things. So I think for me that's how it's all part of one parcel of digital transformation. And if you miss a bit, then you're going to set yourself up for a bit of a challenge later on when you have to go back and ask for an adjustment to timescale or budget or something. Does that make sense?
Yes, it does. No, that's great, thank you. And the final question that's come in: how do you quantify risks to digital transformation?
Yeah, that's a good one. So that's been a little bit harder. I think if you again, to a degree, similar sort of approach. Start with the outcome in mind. What are you trying to achieve? Are you trying to take paper out of your business, for example? Where have you got paper? How much does it cost you to run a business that has got bits of paper floating around it? And that can be metaphorical paper, as in Excel, or it can be real paper. And what does each investment give you for every pound spent? So if you're asking a nominal number, if you're asking for £1 million to build an app on iOS, Android and the web to give a certain set of features, then I assume that £1 million will then be expected to pay back over a reasonable period of time, a couple of years max. What is going to what is going to stop you achieving that. And if you haven't, you probably end up with more risks than you will benefits if you do it properly. And then have a mitigation plan for each risk. And this takes time, it's a bit of effort, this. And for each mitigation plan, you have, if you can, you cost it out. And then you can go to the board. And again, a good board will say to you, what's the sensitivity on your investment plan? And then you can go to the board and say, well, look, I want £1 million. I'm going to do it in a year. Over, after I pay, the payback will maybe, let's just say it's another year. So at the end of the second year, you broke even. But there's a sensitivity on the risks that I profile against this investment could make that payback 3 years or 5 years. And then the board sit there and they really understand what they're signing off on, as opposed to you going back at the end of, say 9 months and going, oh, actually, I've discovered that, we need to go and hire a team of cyber and data people to do this because we haven't thought about that, or we need new infrastructure, or we've got the network bandwidth, or whatever it might be if it's a technical project. So I think those are the sorts of things where if you profile the two together, then you can attribute cost to risk as well as impact and probability or likelihood. And then you can start to sort of piece together a really cohesive plan, and you'll get probably more reception from the board on that than you would otherwise if they're a board that challenges correctly.
Thank you. That's brilliant, Phil. That's been fantastic. Thank you very much. Really appreciate your time and contribution to this webinar. Hope everybody has found the webinar useful. Reach out to us if you'd like to contact us, and also to Phil. Thank you very much.